Well, I think there's a few things going on. I mean, certainly the Fed was at the hawkish end of expectations. Everyone thought it would be a quiet meeting. It wasn't really a quiet meeting. But if you look at what's going on with fixed income, we're having a pretty rare moment of late cycle bear steepening, which is partly the Fed being done, partly the Fed telling you they're going to be done for a long period of time, but there's also issues like lots of bond supply coming and BOJ policy shifts. And so this late cycle bear steepening is what's starting to create that risk aversion in the market.
A lot of people have been talking about the fact that real yields are moving higher. So this move hasn't been led by inflation or inflation expectations. Rather, those have been stable, but it's real yields pushing up nominal yields, which is interesting because it tells you that the full extent of monetary policy tightening delivered by the Fed hasn't been felt yet by the economy. Does that make you nervous about the direction of travel for the U.S. economy looking ahead?
I mean, absolutely. I mean, if you look at just the underlying cyclical data, it looks like things are beginning to slow a bit, certainly outside the U.S., but even inside the U.S. And then you lay on top of that 10-year real yields at the highest levels that we've seen in many years, and that typically leads to something breaking, to something in other asset classes starting to break. So we're at a moment, I think, where we need to worry a little bit about asset markets given the level of real yields.
Jim, you mentioned growth slowing outside of the U.S. and here in the UK, we had the Bank of England last week, in contrast to the Fed, come off less hawkish than expected, and sterling, in the wake of that meeting, has dropped to a 6-month low versus the dollar. Explain to us what you think has driven sterling lower. Is it all about the growth story? Is it simply vanishing rate support there? And what is the appropriate level for cable here?
I think that it's the Bank of England is amongst the G10 central banks probably in the hardest position, that they need to balance an increasingly weaker growth outlook with very sticky high inflation. And so I think part of sterling's weakness is less pricing for Bank of England going forward. I think part of it is this recognition of low growth and high inflation. And I do expect sterling to weaken further from here. I guess the way that I most easily think through the lens of sterling is euro sterling, and we should be looking for levels of 90 at least in the coming months.
Wow, fascinating. And when it comes to the Bank of England's decision to pause here, do you think that was sensible given where the data is?
It was risky, but probably sensible. If you're thinking of a central bank that's truly an inflation targeting central bank, you probably would not be expecting a pause last week. But at the same time, the country around which we've seen the biggest weakening in growth in the last couple of months is the UK. So it's a risky decision, but will probably in the end be the right decision.